Hello, my name is Brian Overby. I'm known as the Options Guy, and welcome to Options Guy TV. What a week we had in the markets. 30% of the S&P 500 index announced earnings this week. A lot of the Magnificent Seven were involved in those earnings reports. We had a Fed meeting. We had some volatility with some predictability in the marketplace. So there were just a lot of things, a lot of words you could use to describe the markets this week. So on Options Guy TV, we always do everything live. We're always rocking and rolling with the markets. And we're going to look at all the paper trades that we did this week. We're going to give a quick summary of the first trade that we talked about. Well, I should say, I guess it was the last trade that we talked about on Wednesday, which was on ExxonMobil. ExxonMobil announced earnings this morning, and Chevron also. They did a pre-announcement. It was just kind of weird. There were some weird things that were going on in the energy space. But ExxonMobil disappointed. We saw that oil has made a big run up, kind of a little bit of a play on that. We had a couple of questions actually about the USO, which is ETF, or maybe it's an ETN, one of those two that track the movements of a barrel of oil and the oil futures. And we're kind of seeing maybe a little bit of a breakout in oil. We're still not quite there. We're just kind of hanging around the $80 mark. The actual chart of oil is a little bit more interesting than the USO chart, but we did see some things in there that kind of made the USO interesting to be considering going into next week. Let's just leave it there. Okay, so on XOM, the trade disappointed, but on Options Guy TV, as usual, if we're looking at trades that always win, well, we can't really talk too much about adjustments. We did our long call spread for the second week in a row where we put it on Monday. And by the end of the week, we've had some profitability on that trade. And we talked about that around earnings, how the markets in this economic environment seem to do well around the earnings reports because a lot of the companies are expected to disappoint. And they just haven't been. And we're supposed to be going into a recession. Now people are saying the soft landing is happening. There's no longer terms of the bumpy landing. Some people are still on the recession side of things, saying we're not quite out of it. The Fed definitely came out and said, well, we're still data dependent. We're going to raise interest rates this time around 1/4 of a point, and there's still a chance we might raise interest rates more. But we are seeing disinflation happening, I guess would be the best way to say that. So inflation is coming down. It's going in the right direction, but the last mile, if you will, in this marathon is always the hardest mile to accomplish. And so we're right around 3% on core inflation, and we'd really like to bring that down to 2%, or at least that's what the Fed is saying. So they're going to keep pushing. They're going to keep pushing, and until they feel confident that we can get to that level, they're not willing to say that they will lower rates or stop raising rates. So just a lot that happened this week in the market. So let's start by just looking at the XOM trade. And I'm going to let you know that we're going to talk about 3 trades today, which it has happened on most Fridays on Options Guy TV. We're still kind of figuring out the pattern of how we're going to address the paper trades week in and week out. But if you ever have any questions about any one of the trades, and we'd like to keep it on topic on the specific trades, or even a question about a specific trade, if you can kind of put it in one sentence, I'll try to address it. But mainly what we're looking at here is what we did this week, and we're going to talk a lot about pricing. And if we get the chance to adjust, we're going to definitely look at that adjustment and talk about why that we adjusted that trade. So with these earnings trades that we've been looking at and around earnings week, we've had really short expirations. We're going to start expanding that a little bit after we get out of earnings. And we'll talk about some longer term trades, some things that we can do with options to maybe, I guess would be a better way to invest as opposed to speculate on an earnings report or on just a short-term move in the marketplace. Okay, so ExxonMobil. Let me pull it up and let's pull up the chain and let's look at it. Like I said, they disappointed. So there we go. Good. It moved. August 28th of July. When we looked at ExxonMobil, the market was right at 105. So we were able to set up a trade that mathematically made sense. In other words, the markets were very well priced. You had a lot of people that are trading those option contracts. So we had very liquid markets, and we straddled the market in XOM. And we did say on Wednesday that we normally put this trade on Thursday because the earnings report was this morning. And it wasn't horrible, but they definitely and Chevron didn't help much at all either. So the combination of both of those earnings reports coming out this morning, we see the market right now down about 2.25%. We bought the 102 call option. So let me click on the ask here inside the Trade Hawk options grid, and that will put it down below. And then the market was at 105. So we literally straddled. We were 3 points in the money. So we bought 3 points out of the money, or sold 3 points out of the money. And right now that is trading for next to nothing, basically zero on the 108. So on our trade, we're now looking at a net debit of 113 on the midpoint. When we put the trade on, we paid $3. On the open this morning, you could have got out closer to $2. I think it was 185. Oh, I actually wrote it down. It was 190. So after the earnings report, the market was showing down pre-market. And then right around 10 o'clock, it was trading right around 180. So what would I have done with this trade? What would be my adjustment to the trade? How might I have hedged it or did something different? Well, my hedge would have been I would have got out. Why? Because we did a one-day trade and we set it up so that there was no time value in the trade. We were literally just trading price. The time value on the option contract that we bought was very similar to the time value on the option contract that we sold, meaning that you're taking the time component out of the price of the options. And it means that it's all just sensitive to intrinsic value or real value. The time value has obviously eroded. You look at the 108, there's no time value left in it. You look at the 102, and even just looking over at the put side of it, there's no, well, here we got right here. So here is the intrinsic value is 111, and the extrinsic value is 6 cents, according to our option chain. So you only have 6 cents of time value left. So the trade worked as planned. We set it up the way that we wanted to. We wanted to be just sensitive to price and take that implied volatility and time premium erosion component out of the trade. And guess what? We got that. So because of that, we still got something to sell, if that makes sense. We were wrong about the direction, and that will happen, especially when you're just speculating on an earnings report. We could set this up maybe if you wanted to get a little bit more bullish, like on something like the USO next week. You could possibly set up a very similar type trade, hoping for a breakout that we're kind of seeing a little bit in the price of oil and the oil chart. So in this instance, we were speculating on earnings. We were incorrect about what direction it would go. Take your comeuppance and move on to the next trade. So I would have sold out this morning, but right now it's trading for 113. So if I had the position on, I'm just showing these as paper trades. And as always, we kind of talk about the fact that we're not really recommending things here. We're just looking how we would adjust a trade on a specific underlying. But if you bought to open, I'm not going to be able to do this in the software. It's going to stop me, but it would usually be a sell to close. So I'll just put sell to open only because I didn't actually have the position on inside this test account. And then on the other one, if you're sold to open, well, then you would be buy to close. And I will just put buy to open. And then you'll see here that it would be a credit. So right now it's a credit of 126. I would get out of the trade. I wouldn't stick around. I don't I don't believe in speculating on price movement, but this would be one of those that I think a lot of people would be hesitant to close it out, right? You put the trade on, you didn't really do that bad. You got the chance that the market could rally into the end of the market. Maybe I should hang around. Maybe I should see if this works out. And in my mind, you just get out. You did the trade. The news wasn't good. The market reacted. And you stick to your plan that you have. And always around earnings, I'm looking at let the markets kind of settle in a half hour mark. And unless I'm really blowing the trade out, like let's say the market made a huge move, more than one standard deviation move to the upside, and I was bullish on it. Well, yeah, maybe I'll hang around to try to make another quarter or maybe even another 15 cents because the market's going in the right direction and it's made a big move in that direction. But if it just kind of goes against you or just kind of is helping you out, I just want to get out. Those are my simple rules of trading around earnings. Okay, so we did a rinse and repeat at the beginning on Monday. I don't know, maybe we'll do another one this Monday coming up because we have a rationale behind why we were doing our long call spreads. And that rationale had to do with what we've seen in the chart around earnings. And you can go all the way back to the inaugural show of Options Guy TV, and we went in great detail and kind of showed the chart and explained everything as to why we were going to be doing long call spreads. And that's been the theme of the last couple of weeks, our long call spreads. We're usually going to try to stick to one strategy over the week. And if that works out, that works out. You just need to have underlyings that make sense. I'm not going to do a strategy just to do it. I want to find an underlying that it would make sense to do that short call spread, for example, or that butterfly trade. Okay. So SPX is at 45.85 and kind of sad news a little bit. The Dow Jones Industrial Average was going to set a record number of up days yesterday. We just needed one more day, and we would have made it. But we went 13 days straight of up days in the Dow, and I guess it's just been a plethora of years since that has ever happened, and it would have been a record if we would have made it 14 days in a row, but the market sold off at the end of the day. So sadness, but still a nice run anyways. SPX is at 45.83. When we did our trade was, let me grab my notes here, 45.45. A lot of fives we got going on our trade this week. We bought the 45.45, sold the 45.50s, okay? And right now it's 4.85. So there would have been opportunities to get out. We put the trade on, we paid $2.80 for it. So the maximum that we could have made on a 5-point wide spread, and it's very obvious that this is 5 points wide, right? Is $5. So the most we could sell it for is $5. I would definitely not stick around right now. As a matter of fact, it actually just hit $5 on the mid, but you're never going to get 5 unless you wait until that expiration date. So keep that in mind. Even if you see the midpoint hit 5, if the market's open, they're not going to give you 5 because that is the maximum value of the trade, right? So that's like going to the couch manufacturer and saying, sell it to me for your cost and don't take any profit whatsoever. So if I'm a market maker and a spread is worth $5, I'm not going to sell it to you for $5. There's no reason to take that trade. So the best you could do on this is 495. Okay. I would probably put it in at 490 right now, and I would get out and let that dime go away and have another successful trade. There would have been an opportunity on Wednesday to get out on this trade, but there was never a need to close out the trade from what I saw in the chart this week. There was never a time where, oh my gosh, I'm losing more than half of what I paid for it. So I would have not gotten out of the trade. Probably would have sold maybe on Wednesday for around 450, 460, and that's how I would have looked at that trade. Okay, so if you have any questions, once again, you can throw them in the comment box. Very interactive show that we have here. We always like to try to address your questions, especially on Friday. Friday is set up to talk about all the trades that we've done during the week and try to address any just general questions you may have. We have one more trade to talk about. Now, this trade was ugly, and I have to admit that. We made the official paper trade on Monday, the long call spread. But we discussed, well, I had somebody ask me during the week about, well, why wouldn't you just do an outright buy? If you were looking at these option contracts and you were really bullish, why wouldn't you have bought the option contract outright? And the very first week, a couple of weeks back, yeah, that would have worked out better because we had a real strong move in the market at the very beginning of earnings, 2 Mondays back. And you're right, that trade would have worked out. So we did look at an out of the money as an alternative trade, and we bought something that was within the 1 standard deviation move on Monday. So it was within the potential move of the market, at least the math of the options market was saying. And we bought the 4605 call. All right. So, well, I guess that just added it. So let me clear it all out because we want to just single that position. And we paid $9.60 for it, which it had a decent delta. I think it was trading right around 30. We had a decent delta saying that we're getting decent stock price representation, but we had to pay a lot more for that out of the money call to have that unlimited upside than we did for our long call spread. But that's where the prices were at. On Wednesday, we came back and the option market made a good move on Tuesday. Well, not the option. The SPX made a good move to the upside on Tuesday, but it all gave it back on Wednesday. And we found that, oh my gosh, that option was now trading for around $5. So we had the move and then they took the move back, but gosh, we really paid for it on that out of the money option contract. So our hedge for the week, and rightfully so, it was obviously fairly smart that we did that. I talked about the fact, well, maybe I would just get out, just close the trade. But if you still want to chip in a chair and you still want to give yourself a little bit of upside, we decided to go on out and as a hedge, sell the 4615 option contract. Okay, so we rolled in to a long put spread. Okay, so this one was a buy and that one was a sell. All right, so that was our trade. We did that. Well, the 4605 call was trading a little bit north of $5, and we sold this one for around $4. Now, remember, our true cost was $9 on our 4605. So we took about half of our risk off the table, and we did not add any margin onto the trade. In other words, there was no additional margin requirement because all we did was roll into a long call spread. Well, there might have been a chance. It never got up to 4615. So I probably wouldn't have gotten out of the trade. There was at some point in time, we were trading fairly close to the 4605, but we're just happy that we did an adjustment, because if we didn't do that adjustment right now, we see that this option contract is only trading for $1, and we paid $9 for the trade. The market wasn't that bad. We started the market this week at 45.55, and actually right now we had a strong move. We're up 1% at 45.87. And this option contract, when it's all said and done at the end of the week, the market went the way that we wanted to, but we lost 90% of our value on our 4605 option. So just like I said, a lot to talk about this week. Very interesting dynamic between the two paper trades, the buying the out of the money option contract and what happened to it, and the long call spread, which that's 2 in a row that were reached almost their maximum profitability by the way that we set up that underlying trade. Okay. So I see we have a comment. We have a question, and I was going to say now's a great time to put your comments and questions in. We're coming to the end of the show. We're trying to keep this right around a half hour, and we'll go a little longer if we get a lot of good questions. So we want to make this as an interactive of a show as we possibly can here on Options Guy TV. Okay, so very good question. We see it on the screen. It says, how come the value of the long SPX option got cut in half so quickly? Well, that is a great question. You were battling two things when you bought an out-of-the-money option in the SPX. First of all, there's a lot of time value in an option contract on an index that's $4,500, north of $4,500. So you pay more if the underlying index or stock is more expensive. Second of all, we had a Fed meeting. The Fed was coming out and was speaking on options. The VIX didn't really show the reaction as much, but the VIX is a 30-day index. Our option contract was a 1-week index. So implied volatility was fairly high on the 4605. By Wednesday, that ball dropped off. So not only did we have the fact that we're buying a fairly expensive option contract, $9 for 1 week on an out-of-the-money option, we had implied volatility come off because the Fed came out and did their announcement. Nothing out of the ordinary happened, but the market always is pricing in the potential that the Fed may have raised interest rates 50 basis points as opposed to 25. So the time decay factor, the fact that 2 days went away on a 5-day option contract, and more importantly, the crunch in implied volatility after the main news event went away. And then let's throw in the fact that the market didn't actually get to the strike, and it was still an out-of-the-money option contract. All of those factors really hurt that price of that out-of-the-money option. And because of that, it got cut in half quicker than it would on a normal week where the Fed is not speaking, right? So we had, I guess effectively what I'm saying, and I'm actually just kind of coming to this conclusion, a Fed meeting in the SPX, as far as the short-term volatility on the option contracts, can act a lot like an earnings report on an individual underlying. Just that simple. So just be aware of that. Be aware that even though you're in an index, which covers almost 500 stocks, it's actually a few short of 500 at this point in time, but around 500 stocks, you still get big fluctuations, I guess, for lack of a better word, in implied volatility around major economic events, more so than just the earnings that are going on in the specific underlying. All right. So if we have any other questions, I don't see any other questions, which is fine for me. It makes my job easy. We'll be back this Monday. We still have earnings rocking and rolling. A couple of big ones that I highlighted. I took a few notes on here. Is we have Apple that's going to be announcing Thursday along with Amazon. So that makes the dynamics of trading either of those two underlyings very interesting because they're announcing on a Thursday, and that means that Friday option contract has 1 day to live. So it's an opportunity to learn. It's an opportunity to learn something about pricing on very liquid underlyings after they announce earnings. So we'll probably look at something at the end of the week in one or both of those underlyings. We also have PayPal announcing on Wednesday. We have Caterpillar announcing on Tuesday. I think that'll say something a little bit about the economy. So I always like to kind of pay attention to Caterpillar's earnings. And there's a whole bunch more. So I would guess another 30% or so of the SPX is going to be announcing next week. And if you do the math there, we're getting to the end of earnings season then after next week. And then we'll kind of look at some more conservative trades here on Options Guy TV. So thanks for coming. Please click subscribe, ring the bell so you get all the alerts for Options Guy TV. And we'll see you this Monday 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming.